Well, good morning, everyone, and welcome to today's small business webinar. My name is Paul LaChapelle. I'm with Montana State University Extension and very happy to welcome you all to the webinar and to be hosting today's webinar. I'd like to remind you all that we are recording today's small business webinar, and we'll be posting that archive link on our website and also mailing it out to our listserv. That link is in the the Q&A box there in the lower left corner. Hoping all of you can hear me. I think that there's some audio issues for one of you, but you can see the tech number you can call and the email address. So please just shoot me an email or give a call if I can address any tech questions for you. Today's webinar is sponsored by the Small Business Development Centers, which are affiliated with the Montana Department of Commerce and the U.S. Small Business Administration, Montana Economic Developers Association, MSU Extension, with additional support from the Great Falls Development Authority and the University of Montana. You will have an opportunity to ask questions there in the Q&A box, so go ahead and type those in anytime during the presentation, and our presenter Wendy will be monitoring the Q&A box, and I will as well, and she'll answer those throughout the presentation. So now I'd like to introduce today's presenter. Wendy Wiseman is a certified public accountant and certified QuickBooks Pro Advisor based in Great Falls, Montana. Today she'll be talking about basic accounting for successful entrepreneurs. So with that, I'll turn it over to Wendy. Wendy, thank you for joining us. Look forward to hearing your information.
Thank you. And can you guys all hear me? Maybe not Jean.
Yep.
Paul, can you help Jean get on her audio?
Yep, will do. Thank you.
Okay. Can you guys, the rest of you all hear me okay?
Yep.
Great. Okay, great. So feel free to type in questions as I go along if you have any issues or questions. So we'll get started. Awesome. Okay. So we're going to be talking about some basic accounting and basically talking about your balance sheet, which, by the way, is the most misunderstood statement. Okay, so we're going to talk about that today. So here are your basic accounting rules when you talk about accounting transactions. Okay, every accounting transaction, no matter what your accounting system is, has two sides, and they're called a debit and a credit. Okay, and those two sides obviously have to balance. So your accounting equation has to balance. Okay, so what is this accounting equation? Okay, here's your accounting equation. Your assets of your organization must match your liabilities plus your equity. So what the heck does that mean? Assets equal liabilities plus equity. What that means is that assets are things that your company owns. Okay, your company can own cash, investments, accounts receivable, equipment, buildings. Your company can own a bunch of stuff. And when we talk about accounts receivable, one thing I want to point out about accounts receivable is that what goes into accounts receivable has to come out. So your accounts receivable is a current listing of who owes you what. And as you bill people, that amount goes up. As they pay you, that amount goes down. Okay, so these are things that a company can own. And your company obviously can have other things. You could have inventory. You could have prepaid assets. You could have goodwill. You could have other things on that list. Okay, so how does your company acquire these assets? So there are three basic ways you can acquire assets. You can borrow the money, you can put your own money in, or you can use money already earned in the business and pay cash for those assets. Okay? So those are how you acquire those assets. So I really like this schematic. I found this on the web a couple years ago. So here, right here, all of your assets. Okay, this is everything you own. So how did you get those assets? You either borrowed the money from creditors, and those are called liabilities, or you use your own money or money within the business. And that's called equity. So every asset has to either be acquired by debt or by equity. Okay, and that's kind of the basis of a balance sheet. If you think about a balance sheet, you have your assets listed on the top, then you have your debt, and then you have your equity. So debt is how you acquire those assets based on debt, and then equity is your money that you've either earned or put in. Okay, so let's talk about this debt. They're called liabilities. Okay, this is the portion of the business that's basically owned by creditors. So if you are very debt heavy or you're very leveraged, this could be a big number. Okay, so this is money you borrowed, can be short term, accounts payable, taxes payable. We hope you pay your taxes short term, credit cards, or it could be long term, vehicle loans, mortgages, other type of bank loans. And the difference between the short term and the long term really has to do with how you analyze your business. You really do want enough cash on hand to pay off your short term debt. Theoretically. Okay. Okay, so more on liabilities and debt. The interesting thing is about debt is what goes in has to come out. So if you put debt or liabilities on your balance sheet, there has to be a plan to get them either paid off, written off, but you do owe that money. Or, worst case scenario, you declare bankruptcy. But theoretically, what goes in as debt on a normal situation gets paid off as debt. Okay, so that's an in and out situation. I want you to think about a liability as what goes in has to come out. Okay, so now let's talk about this equity thing that's on your balance sheet. This is the least understood word in accounting. And this is the portion of the business that's owned by you. So theoretically, you take all of your assets, you pay off your debt, and this is what's left, at least on paper. So on paper, the equity is what your business is worth. Now, I say on paper because your assets don't typically include the goodwill, the value of a client list, the value of your employees, whatever your business name is worth. If you're McDonald's, that name is worth a lot of money, although it may not be reflected on your balance sheet as an actual asset. Okay, so this is your equity. So what are the different types of equity? Okay, there's obviously net income. Remember, net income are your profits, which we're going to talk about in a few minutes. Okay, you can have retained earnings. Now, this is another word that you've probably heard before, but maybe not understood what retained earnings are. This is the net income or loss from prior years, since the beginning of time. These are earnings that are retained in the business. So every year, those get reset to zero, kind of like on your income tax return. Every January 1st, you start all over with new wages. Okay, so at the end of the year, all of your profit, your income, gets rolled into last year's retained earnings. So returned earnings, hopefully you have profits that are building up year after year after year. Okay, in addition to retained earnings, you can have shareholder contributions or distributions. You can put in your own money, or you can take out your own money. So this is personal money. This is not income. A lot of people tend to put their own money into their QuickBooks file or their accounting system as income. If you do that, you are going to pay taxes on it again. Okay, so this is not income to pay taxes on. This is straight equity. So if you were to put $10,000 into your business today because your business needs money, that your business is worth $10,000 more today than it was worth yesterday because of that investment. Okay, if you are a public company or a corporation, you could also have stock. If you're a big corporation, you can sell stock, and that's the other way that you can gain equity. Okay. So the main pieces, though, of equity are your retained earnings. Hopefully, it's not retained losses. Retained earnings and profit from prior years. So that's how you build equity. Okay. So there you go. How to build equity. You can put in your own money. I mean, that's one way, especially in the beginning of a company or as you're growing, you may need to put in your own money. You can have profits from your business or you can issue stock. Okay, so that's how you build equity into your business. Now, we have not yet talked about profits. Okay, this is obviously one way to build equity in your business, and this is really the way you're going to make money to pay off those loans and to buy those assets. Okay, but again, your profit is one piece of your equity. Okay, so to have profits, obviously you have revenues minus expenses. Okay, so these are your type of expenses, and obviously yours could be different. You could have payroll, insurance, professional fees, cost of goods sold, office supplies, fuel, bank fees, interest, utilities. Your business could have other types of expenses, but these are the types of expenses that most organizations have. Okay, now let's talk about this double entry accounting. When I first started, I said that every accounting transaction has two sides. Okay, so that's what we're going to get into next, recording transactions into your accounting system. Every accounting transaction has two sides, and those two sides have to make the assets equal the liabilities plus the equity balance. Okay, so let's talk about some examples. So here's an example of an accounting transaction. You sell a product or service for cash. Okay, so what two things get affected when you sell a product for cash? Your revenue obviously goes up. Okay, don't forget, revenue is in the equity section of this equation. And obviously your cash goes up. And cash is in the asset section of your equation. So for the equation assets equal liabilities and equity, assets go up and equity goes up and the world is in balance. So in this particular situation, assets go up, equity goes up. And the asset itself is called the cash. Okay, so that's a great thing when you sell a product for cash. Okay, so let's do that same example, but we sell it on credit. Like in my accounting career, in my accounting business, I typically don't sell a service on cash. People don't typically bring me cash when I'm finished with something. I bill it. I send out an invoice. Okay, so what happens when you send out an invoice or you bill it? Okay, so what two accounts are affected here? Your revenue goes up because you earned that money. However, you do not yet have the cash. Okay, but what do you have? You have an accounts receivable. Okay, so your assets still go up, but it's not cash, it's an accounts receivable. So in total, this transaction will have the same effect as selling a product for cash, except you don't have the cash right now. You have an accounts receivable. So your assets go up, your accounts receivable goes up, and your equity goes up because your revenue goes up. And your world is in balance still. Okay? Now, what happens when you receive that payment? 3 weeks later, 2 weeks later, a month later, sometimes a year later, okay? Your cash goes up, of course, but your accounts receivable now goes down. Think about accounts receivable as a listing of money that clients or people owe you, okay? So the accounts receivable goes down, your cash goes up. So in this situation, all that's happening is that your assets both go up and down at the same time. Your cash goes up, your receivable goes up, and you have no effect on equity and no effect on your liabilities. So you show, in theory, you show no profit when you collect that money from your receivable. The profit was shown when you actually did the billing and when you actually did the work, when you sent that invoice to that customer. Okay? You guys okay so far? No questions so far. Great. Okay, I want to compare the sale of cash versus the sale of credit. The only difference is that both of them, you affect your assets and you affect your equity. But one, you're still waiting on the cash, and the other, you have the cash up front. Okay, so financial statement wise, there's really no difference between billing it and collecting the cash up front. It's just you don't have the cash, but you'll get the cash eventually, hopefully. Okay, now let's talk about the expense side. Okay, now we're going to go to an office supply store and we're going to purchase a ream of paper with a check. I know nobody really does that anymore, but we're going to do that. Okay, so what happens here? Your expenses go up. But think about an expense. An expense is a reduction of equity. So your equity goes down and your cash goes down. Okay, so when we look at this equation, cash goes down, assets go down, equity goes down, and your equation is still in balance. You have less assets, you have less equity, but your equation is still in balance. Okay, we're going to do that same thing, except that we're going to go to the office supply store and they're going to send us a bill. I do that all the time with Pickwicks. We order stuff and they send me a monthly bill. So you still have an expense when you purchase that paper. However, because you haven't paid for it yet, your assets are not affected. But your accounts payable, your liabilities are affected because you owe that money out. Okay, so the assets were not affected, but the liabilities were. So your accounts payable goes up and your equity goes down. So you notice there's no effect on the assets, but your accounts payable goes up and your equity goes down when you buy some paper on accounts payable. So now it's time to pay that bill. So now what happens? Cash goes down because you just paid the bill, and your listing of your accounts payable goes down. So cash goes down, accounts payable goes down because you no longer owe that money, and your equation still balances. Your cash goes down, your assets go down, your liabilities go down. No effect on equity when you pay the bill. The effect on equity was when you bought those supplies. Okay? Good. Okay, let's talk about making a loan payment. Loan payments are really tricky. Loan payments actually have three pieces. Okay? I want you to think about the fact that making a loan payment is not an expense. Okay? It's not an expense because it's a liability payment. Remember, expenses go on your profit and loss. These are loan payments. Okay? So there's actually three accounts that get affected when you make a loan payment. Obviously, your assets go down. The whole amount of the check that you write for your loan payment, your assets go down for the whole amount of the check. Your liabilities go down, but only for the amount of the principal of the loan. Remember that in a loan situation, what goes in has to come out. Can't take out more than what you put in. You're not going to pay back more than the amount of the actual loan. The additional money you're putting in is for interest, and that is an expense because that amount is above and beyond the actual amount of the loan. Okay, so if you borrow $10,000 and you wind up paying back $12,000 with the interest, only $10,000 can go back against the loan. The other $2,000 is your interest. So that becomes an expense and not a liability payment. Okay. So I want to talk now about the difference between an asset and an expense. And this can get a little tricky sometimes. Okay, if you buy a $500 iPad, is that an office supply or is that an asset like machinery and equipment? So that's because I have clients that do both. Sometimes they put the iPad as an office supply. Sometimes they put the iPad as an asset to the business. Okay, so assets to your business, and the definition of an asset is something that has future value, and they're typically pretty large. If you buy a $5,000 copier, that's probably an asset and not an office supply. Okay? Expenses, office supply expenses happened in the past. So payroll has already happened. Utilities have already happened. Okay, these are things that have happened in the past. And an asset has future value. So assets are usually larger. Equipment, buildings, vehicles, things like that. So the threshold for the difference between an asset and an expense is usually a company policy. The bigger your company, probably the larger that threshold is. Okay, my company happens to be $500. That's my limit. So if I buy something for more than $500, I typically put it as an asset and depreciate it. But for a big company like Microsoft or some other big, or Amazon, I'm sure their limit might be $10,000. So it just totally depends on your company. Most companies have a policy that they give to their accounting staff that differentiate between an asset and an expense. Okay. So again, assets have future value. You can do something with them. Equipment has future value. What's that value? It can help you generate revenues in the future. Typically, that's the value. Why do you buy, if you're a delivery company, why do you buy a truck? To be able to generate revenues. I buy computers for my staff to help them do their job. And that's the future value of that computer. Okay. I want to talk a little bit about cash versus profit. And there's a big misnomer out there that if you have cash, you have a profit. And that's not necessarily true. Okay? A business can have a profit and have no cash to pay the taxes on that profit. A business can also have cash but show a loss. Confused yet? I'm going to show you how this can happen. Okay? So here's a situation where you have cash and no profit. Two situations, okay? A business receives a payment on an old receivable. Remember that accounts receivable is based on when you build your product or your service, okay? So it's recorded as revenue, profit, when you actually perform that service. So if you don't get money for a year or two, or you have to send them to collections and it takes a while for you to get the money, you could have money and that revenue was recorded 2 or 3 years ago. Okay, so you could have cash and no profit. I had a client that did this a few years ago. They had a big fire sale. They were trying to unload old inventory. So they had a big sale. They sold a bunch of stuff at a loss. They had a lot of cash. but those items were sold at a loss. They may have paid $100 for an item 5 years ago, and now they're going to sell it for $80. They have a loss on that item. However, they have a lot of cash right now. So they were a little confused because they had a loss on their taxes the year they had a big fire sale, and they were prepared to pay a bunch of taxes, and they didn't owe anything, and they really thought I was doing something wrong on their tax return. But no, they actually sold their stuff at a loss. Okay, here's a situation where you can have profit and no cash. I have situations where a lot of clients make money and then they have no way of paying those taxes because they have no cash. If you are making significant debt payments, don't forget, debt payments, loan payments require cash. But you pay taxes on your profit, okay? And the profit does not include those loan payments, because those loan payments are a reduction of a liability. Therefore, cash is needed to pay down the debt, but it is not deductible on your tax return. So you could have spent, say you're making $2,000 a month loan payments. You have paid off, you've taken $24,000 of cash and paid off debt. But those payments are not deductible. So you have $24,000 of profit. You've had to take that money as to come out of your profits. So now you owe taxes on $24,000 that you don't have cash for. So that's one way you could have profit, no cash. Or you could have large capital assets were purchased with cash. You went out and bought a $20,000 piece of machinery or a $20,000 vehicle. That is not an expense. That's an asset. Remember, we talked about assets versus expenses. Okay, so you're putting an asset on your books that you will have to depreciate. But all of a sudden you took out $30,000 of cash out of your business to buy an asset that you don't get to expense for tax purposes. So you could have profit and no money to pay those taxes. Okay. Any questions on this? Because this is interesting. I see a lot of clients that wind up with profit and no money. And they are just very confused on how that can happen. But especially if you have debt payments or you're buying a lot of assets, that's how that can happen. Okay. So that's all I had. Do you guys have any? I don't see any questions. You guys have any questions? Nobody's typed in any questions. No?
Well.
Any questions?
We have a couple of minutes left for questions, so if anybody has any, encourage you to type those in now. Again, that's in the Q&A box. Wendy, do you want to just tell us again about your availability for follow-up questions, or
sure.
If folks want to get in touch with you?
Sure. I'm hard to reach on the phone. Actually, I'm virtually impossible to reach on the phone. Because most of my day is spent at clients cleaning up QuickBooks files. Mainly what I do is I'm a QuickBooks trainer. So you can either email me if you keep this slide or write this information down. You can email me. I'm pretty good at email. Or you can try calling my office. I do have 2 people in my office that are very good at QuickBooks. If you happen to have a QuickBooks question that they can answer for you. Or here's my new texting number. This is a work texting number. You can text me and I can always get back to you. If I need to schedule a call with you, I can always do that. But email is probably the best way to reach me. So, no questions right now?
Thanks.
No questions, but yeah, so this presentation was more on, understanding balance sheets and the difference between cash and profit. Because a lot of people just don't understand that.
Thanks, Wendy.
No question?
Well, we'll assume that you provide such clarity and detail that folks didn't have any follow-up questions, but they can certainly get in touch with you again, preferably by email then. And
Yeah, if they can, or they can text me. That'll be fine too. Oh, Gloria's typing. Oh, cool. Okay, thank you.
All
Thanks.
right. Well, while I'm announcing our next webinar, I'll also just remind everybody that Jason will be sending out a survey with some questions about the webinar and so look for that for those of you that have registered. Our next webinar is Thursday, August 1st. Again, same time, 11 a.m. By Colin Lee. Colin Lee, he is a commercial insurance producer with Cogswell Insurance in Great Falls, and he'll be talking about insurance for small business. So again, you can access all of our previous recordings and other related information on the website there, the small business website. And you can also download Wendy's presentation from today in the little file box there. You can just click on that file name, that PDF, and that's a complete presentation from today. Basic Accounting for Successful Entrepreneurs is the file name. Wendy, any last minute comments from you?
No, I think that's good. Just yeah, if you have anything, let me know, and I'm happy to help you any
Wonderful.
way I can.
Wendy, thank you again for the great information, and for all of our participants, thanks for joining us, and enjoy the rest of July, and we will see you August 1st for our next webinar. Thanks, everyone.
Take care, guys. Thank you.